S&P released its annual SPIVA report last week. This looks at the performance, those of you who don't know, of active managers against passive benchmarks. It's sort of the gold standard on how that debate goes. On the surface, this looked like very good news for active managers. 49% of large cap managers beat the benchmark, 51% underperformed. That sounds terrible, but actually, this was the best performance since 2009 for active management overall. And yet, underneath that, 2022 had some very unusual tailwinds that might not be repeated. Dan, tell us a little bit about those tailwinds. The average stock outperformed the S&P, but big cap tech underperformed. That was a big factor.
It was. So if you think back, 2021, going into last year, 85% of big cap active managers underperformed the S&P 500. Conditions changed a lot last year that we know. S&P 500 total return, as well as even investment grade fixed income, were both down 18%, total return last year. So conditions meant correlations were high, but importantly, dispersion was high. Those are two critical variables for active managers to outperform, to take more concentrated risk in their portfolios. And you saw some of the results. The question is, they still 51% underperformed. The question is, can they sustain it? Generally, active management tends to be a zero-sum game. They need the really poor active managers to be even poorer to get that alpha.
Yeah, this is a statistical point that's very important for people to understand. The average stock outperformed the S&P 500. Big tech underperformed. In years before, big tech has been so big and powerful that when it outperforms, the rest of the market often will underperform. So you could have 100 stocks on the S&P up in a year and 400 down, and the S&P will be up because the big cap tech stocks move. That didn't happen last year. And so statistically, it's very important. What your authors pointed out was it's not quite a dartboard effect, but your chances of outperforming are very high when the average stock outperforms the S&P 500. It's not quite throwing darts at a board, but statistically, they can demonstrate that your chances of outperforming are better.
That's right.
You used the word dispersion. I had to define that when smart guys like you say that. I have to define what you're talking about.
I think in theory, though, dispersion, should have been higher last year. So people's view on what a stock is worth versus the spot price, should have been a lot wider, and you should have had more opportunity to outperform. But I think, what we find is that there's this massive, influx into ETFs. U.S. large cap index is very difficult to outperform. So you're kind of better off being in active managers in like small caps, mid caps, international bonds. I think U.S. large cap is just very, very difficult to outperform, and and the SPIVA report shows it.
So the takeaway, and this is very important about long term, what's really going on here, and I use the same line for years. 91% of large cap managers underperform after 10 years. Now you have many different variables, but for large cap, after 10 years, 91% underperform. That's a pretty dismal fact. And here, the other important point that you bring out that I think is really one of the reasons your report is sort of the gold standard is the survivorship bias. Hedge funds like to point out, I outperform 90% of all hedge funds, but they only take hedge funds that have been surviving 10 years. And as it turns out, a vast numbers of funds, mutual funds, close because they're terrible, because they underperform. And the number is something like 30% over a 10-year period don't survive 10 years. So you account for that survivorship bias, because if I'm trapped in that stock and it closes after 6 years, I still lost money, even if it doesn't show up in some hedge fund index somewhere.
That's exactly right. So you're getting the true apples to apples comparison through the survivorship, also making sure that things like the largest share classes, and we're not double counting on share classes. So and in addition to the relative performance of passive versus active, and that outperformance, if you will, for passive, we've saved investors over $400 billion in fees over the past 26 years across the 500, 400, 600 indices, product-related indices.
Why don't active managers ever outperform? What's the problem? Can you summarize it?
I think they charge too much. So the more fees you pay, then that detracts in return. There's not enough dispersion in, like, let's say, U.S. large cap. They don't take as much active bets, right? Like when you read sometimes what a portfolio manager owns in their large cap, active mutual funds, it's like basically the same stocks as the S&P. So you have to do something different than the S&P if you want to outperform. Sounds trivial, but that's just something that they don't do.
This is why Cathie Wood's so famous. I mean, she's sort of the anti-S&P. She's a fund manager that took bets outside the norm. She became famous. She briefly was enormous performance and struggled.
I mean, look, you have some incredibly smart, talented people competing with each other, cats and dogs every day.
Yeah, well, that's the key point. There's no competitive advantage. I mean, 50 years ago, you had less information dispersion. A few people might have been able to outperform and do a little bit better than the rest of the crowd. But it's, people ask me, why are the fund managers so stupid? They're not stupid. Actually, it's the opposite problem. Right. They're really smart. They're all really smart. And when you have a room full of 99% geniuses, it's going to be hard to outperform on that test. And that's why they keep referring to, I find it annoying, but retail is dumb money because they're often not as well informed as the professional investor. Right. And there's few of that around, fewer retail traders that are actually around these days. On Friday, Dan, I want to go back to indexing. The S&P is going to see a rebalance in its sectors, and I'll make this simple. There's two major ones. There's a number of things that are happening here, but Target, Dollar General, and Dollar Tree are going to move from consumer discretionary to consumer staples. So we're going to see consumer staples get bigger and discretionary get a little smaller. And then Visa, MasterCard, PayPal, and a few others are going to move from technology to financials. So technology is going to get a little smaller, and financials are going to get a little bigger. This is the annual change, what we call the GICS classification system. I love saying GICS. Explain it.
General Index Classification System. You're right. So this was something that S&P Dow Jones Indices, in partnership with MSCI, really started in 1999, and it had, I think, a big impact on helping standardize and the growth of passive investing, and really, especially in global equities, giving them this classification system. So this is a formal process. We go through open public consultations to get feedback from all market participants. But the key is making sure these indices are relevant. Yeah. Are they reflecting changes in consumer demand, or are they changes in the marketplace structure, and getting open consultations to make sure this system remains relevant?
Well, I like to say these reflect common sense changes. For example, I got asked for years, why is Walmart a consumer staples and Target is a consumer discretionary? And I'd say, I don't know. Ask S&P and MSCI. They are, it seems to me. And now they're sort of recognizing that. I don't think Visa is a technology stock. I think Visa is a financial stock. I mean, common sense would say yes, but they're finally recognizing that.
Well, if you think over time, sorry to interrupt. I think the retail is a great example. That previously, before internet shopping, in many ways, you thought about how retailers distribute, and maybe that is a criteria. Today's world, the distribution matters less. What do they sell? What are the products? And I think taking that type of input to ensure that an industry group is defined the right way is important.
Yeah, and you've made other big changes. When you took REITs out and created a whole 11th sector there, that was a common sense thing. REITs are, real estate's a separate category to me from financials. John, when we used to do this 30 years ago, this was sort of a nice academic discussion, but now there's a lot of money. Yeah. And this is why I keep bringing this up. I always like to say, you supervise the biggest, fund management company in the world, essentially, because so much is indexed, so much money is indexed.
We're not a fiduciary. It's why
I understand
John next to me.
I understand that, but what you guys determine in the S&P and in the Dow Jones Industrial Average, there's real money to it now. 30 years ago, we were a bunch of academics talking about it.
But I think the crucial thing is you break a good point, because the independence of what we do, to have standards, to have benchmarks and these indices, not only for passive, but for active, to do performance attribution, risk attribution. That's why to have this separation with a fiduciary like John, that is crucial, because trust is what builds the markets. And having independent benchmarks, transparent benchmarks is crucial.
$7 trillion indexed to the S&P 500. And that's only the guys who pay you. We don't even know, I haven't seen a number of how many, I call them closet indexers, guys who, benchmark to the S&P 500 but won't pay you for a licensing fee. I don't even know how big that is, but it's probably as big as the $7 trillion. $7 trillion is what, 18, 19, 20% of the S&P's value
and
right
that's
now.
why it's hard to beat the S&P.
Well, there you go.
So much money tracking it, and you don't have it.
So what's the implication for investors? I often say index providers are the biggest fund managers in the world. I know you get antsy about that, but you understand my point. What's the implication?
I think if you're trading like XLP, XLY, XLK, XLF, you have to understand now that there's different stocks that are going to be put into these ETFs. So you need to be mindful of your risk. So again, you always use a portfolio construction tool, look under the hood, see what the aggregated risk is before and after. So these are good changes, and your firm consults, a lot of independent people. We've been asked to participate. So, they make a lot of sense to me. But unless you're trading like sector products, I think, for the most part, if you're just buying VTI, VOO, IVV, generally speaking, you're not going to have much to worry about.
Yeah, those are S&P 500 indexes that are out there. I get this asked every time, every time there's a change in the S&P 500, somebody, a half a dozen people will index me and say, how does this committee work that the S&P 500 has? Now, you are the CEO of indexing.
That's right.
So you are not on the committees that make
not.
these determinations. There's an S&P 500 committee, determine what goes in and out. They meet. You're not on the committee.
No.
There's a Dow Jones Industrial committee. They meet. You're not on that committee.
Correct.
Okay, you all know that. He's not on the committee. With all of that said, explain how, for example, the S&P 500, how often does it work? How many people are in it? And what?
Well, again, I think this is the crucial thing. Is if you think of what we're trying to accomplish is to create, again, these independent, transparent benchmarks, not managing money. That's crucial because for those who do, and their fund boards and other fiduciaries dependent on, they need some level of true independence to prove their performance and risk attribution. But for us, we keep an independent process. We, again, have public consultations from all market participants that will go into that committee. All the methodologies are published online.
Yeah.
You can go right now in terms of online. Once public information becomes available, it'll come to me the same time it does to you or anyone else in the marketplace.
Now, first off, how often does the S&P 500 committee? I know there's dozens of these committees. How often does that meet?
Well, it depends. Like something like Friday, they had to make a decision. They will meet ad hoc, and there are formal meetings as well. But as appropriate for them to make decisions.
And how many people are on the committee? That a dozen or 15?
We don't really disclose that type of.
And you don't disclose who's on it.
We
as well,
put
right?
the methodologies, the changes, all of that is public information, and some of it can be market sensitive. So that's where the independence and the separation of our analytical and commercial activities are very well documented, and making sure that we keep market trust and respect.
But the size of the committee and the people who are on the committee is not publicly.
No, we don't make that. It's broader employee information we don't disclose as a company.
Yeah, and so the committee will meet. They'll come out and make a decision. Let's just say about a new stock going in the S&P 500. They report to you, right?
I'm the CEO responsible for the business.
Right.
But in terms of their mandate, again, which is defined, publicly disclosed on their methodologies, what have you, on the website, they will be able to act, and then they have a responsibility to publicly disclose any potential changes on that through our process.
And is there any public input? I mean, do they go around? Is there any way for the public to say,
Absolutely.
let's? I think XYZ stocks should be in the S&P 500. I mean, people think, and it's convenient to say the S&P is the 500 largest companies in the United States, and it usually is. But there were instances, Tesla, for example, where it wasn't yet in there, and it was one of the biggest ones. So it's
Well, I think we talked about earlier, like I said, the exchanges. This was all the result of public consultation. So for us, monitoring, going to the public, getting John's feedback, as well as anyone in the marketplace to provide.
So are there
within the methodology?
Do you publicly say
guidelines?
we'd like input, or how is that?
Absolutely. There will be a request, a public press release asking for consultations. A date and time will be presented for that kind of discussion.
Okay.
Yeah.
John, you like this process? This seems to be the process that works the most. The world has gone to indexing, and it's gone to indexing because exactly what we just talked about, the inability of active management to outperform and the high cost of that. This is a logical response, but they now have become very powerful.
Yeah, I mean, I think Tesla was the kind of behemoth, right? Because it wasn't added. I mean, you have to have 4 quarters of net positive earnings in order to be included into any S&P index, and I think that was something that hung up on Tesla a lot. But the more quantitative and systematic the index is, I think the better for everyone, so that there's no surprises.
Okay.
So, yeah, I think we're emphasizing any marketplace, whether it's equity or financial, depends on trust. Buyers and sellers feel that, and that's where having these standards, this independent, away from being a fiduciary, not biased by managing money or having that fiduciary responsibility, it's crucial. Having independent data, benchmarks, and ultimately indices, that's what gives people kind of the independent trust to be able to transact effectively.